I'm happy to welcome you to the Sparebanken Sør presentation for the first quarter of 2022. And we'll tape this presentation and the Q&A session and publish it on sor.no. I expect to keep talking for around 30-35 minutes, and there'll be time for some Q&As afterwards. Welcome, and let me start with the agenda for today's presentation. The topics I want to highlight, I'll go into Sparebanken Sør and some major issues concerning Sparebanken Sør this quarter. The financial highlights, of course, the funding status, the capital situation, and the new dividend policy that we launched last month, and the goals and expectation that we will work on further on. Sparebanken Sør is a leading financial institution in Southern Norway, and we have a very stable market situation in our region. We have a very strong presence in the county of Agder, a growing position in Vestfold Telemark, especially strong position in Telemark, and also a growing and sort of interesting growth potential in Rogaland, where we've been positioned for the last 4 years through branch establishment. We're a financial group with all different kinds of banking services, securities, real estate brokerage, and also distribution of a number of other different financial products, insurance products, and I'll get back to that. We had a solid growth this quarter, and also a good development that I'll get into. First of all, the situation in our region for us regarding mortgage lending is stable and strong. We are maintaining a very high market share in Agder, and as well a strong market share in the neighboring counties, Rogaland and Vestfold Telemark, and growing definitely in areas like Vestfold Telemark. We see simultaneously now that there is a good development in house prices in our region, actually a little bit above the regional or the level nationally, and from a lower level actually, but still a solid development in house prices in a quite a healthy housing market in this region. One way of explaining that is, of course, through the NERS index. That is a popular sort of way of showing the sustainability of the housing market in the different parts of Norway. What you see here is our main area, the south part of Norway, where our main metropolitan areas would be Kristiansand and Porsgrunn, Skien. We have the NERS index showing quite high values, and the NERS index is a way to showing the proportion of homes sold each year that a single nurse with a normal income has the opportunity to buy, based of course on income and lending regulation prerequisites. And what we see here is that in our main geographical area, this NERS index is among the highest in Norway, and far above the more larger cities and more pressured housing areas, which gives a very strong indication of a more robust housing market, and also, in our opinion, a lower downside on the housing market, and also, of course, mortgages in our main area. Another very strong sign of robustness is, of course, the unemployment rate and employment growth in the southern part of Norway, and that is the southern region, which is Agder and Vestfold Telemark, where we see first of all at the moment very low unemployment rates, actually lower than the situation pre-pandemic. We're actually back on a very low unemployment level, indicating a strong employment market and also good employment growth. What we also see is good and expected good and strong growth in investments and production in our region, both within the industries or in production in different parts of the industries in our region, and also strong investments actually in the southern region at the moment, far above the average of Norway. Let me go into the financial highlights. First of all, we see a strong growth in net interest income in the first quarter of 2022. Actually, a growth of 70 million NOK, which indicates a strong growth in both loans and of course margins. I'll get back to that. We see also positive development in net commission income. On the other hand, negative profit contribution from the liquidity portfolio is reducing the profit before tax, whereas we have major positive results from basis swaps, which are shown as a comprehensive income for the period, and does represent quite a high increase in OCI compared to normal situation. We also see a solid growth in profit overall from ordinary operations, a return on equity after tax of 7.8%, which is somewhat under our ambitions, but mostly caused by a negative profit contribution from the liquidity portfolio. And we have a 12-month lending growth of 4.5%, which is a little bit below our ambition, but still we believe that we'll have a strong or we'll be able to deliver the growth as we have ambitions for the rest of the year. And we also have a solid deposit growth of 6.4%. And also increasing the common equity tier 1 up to 16.7% from 16.4% last quarter, and also a leverage ratio of 9.3%, which is quite solid compared to most other larger Norwegian saving banks. If we decompose the changes in profits before tax, you see that the net interest income is a major driver of this positive change. Net commissions are also increasing somewhat, and the net income from financial instruments do have a negative effect on the profit before tax, as well as some increase in total expenses, which I'll get back to, and also even though we have very low loan losses, it's a little bit more than the equal quarter in 2021. And as I mentioned beforehand, we have positive results from basis swaps, so actually 150 million before tax that we present as other comprehensive income. When it comes to profit and returns, our operating expenses have shown an increase of 7.3% from first quarter of 2021, whereas the profit from ordinary operations show an increase of 13.6%. Our return on equity is 7.8, 8.2 excluding financial instruments and non-recurring events, and the cost to income ratio is 42, whereas it's when you look at the cost income ratio for our banking operations, it's a little more than 38%. Further on, to explain those items that affect the costs, these are mainly investments in strategic initiatives. The main driver of our 7% increase in operating expenses is actually from strategic initiatives, costs related to the IRB process, of course, investments in distribution power of other income, and also of increased investments in compliance caused by, of course, increased government regulations. The underlying cost growth is fairly controlled and fairly low. When it comes to lending and deposit growth, we have a net loan development 4.5% 12-month growth, 5% for retail customers, 3.4% for corporate customers, and annualized growth in this quarter is lowered for the retail customers, close to 3%, and 7% for corporate customers. To give you a guidance of the rest of the year, we believe that the corporate customer growth will be lower, whereas the retail customer growth will be higher. We have an ambition of 6% for retail customers and a lower 3% for corporate customers. When it comes to deposits, we see a 12-month growth of more than 6% and somewhat more for the corporate customer segment and around 6% for retail customers. And also a deposit as share of net loans, deposit ratio of close to 55%, which is solid for the group as a whole. And we also see, as I mentioned in the beginning, a very positive development in net interest income, actually a growth of 15.5% during the last 12 months. Quite, in our opinion, a healthy deposit and lending growth. We have, of course, repriced the lending, but also some of the deposits. But as you will see, the increase in margins is happening on the deposit side. And we also announced an interest rate change a couple of months ago in the end of February. In March, actually, when with an effect on the retail side from May 11th, which we believe will give us about an estimated 85 million NOK positive effect annually. That means that we believe that the net interest income on a quarterly basis will in the last 2 quarters reach around 550 million when it comes to net interest income quarterly. This is a way of describing how the profitability is influenced. We see a definite strong increase in deposit margins and reduced lending margins, of course, because of the NIBOR development over the last months. We see the loan margins do sink in the retail market, whereas the corporate market is fairly stable. There's a lot of NIBOR 3 months loans in the commercial in the corporate market, whereas the deposit margins both in the retail market and the corporate markets has shown quite a strong development and increase. And sum up, as you see, the interest margin, that is the average lending rate minus the average deposit rate, has shown also quite a strong development during the last 2 quarters, both in the retail market and in the corporate market. When it comes to other areas of increased, we have rather strong ambitions for increased other income in Sparebanken Sør. That is income from insurance and credit intermediation, leasing, securities business, that is typically securities trading as from Sparebanken Sør markets and investment funds. And also income from wholly and partly owned companies, typical Frende, Norne, Brage, as I'll come back to. We've seen good development in these areas, on these items, on provisions or income, other income from these areas during this quarter, except the income from wholly and partly owned companies, where the negative financial result in Frende and Frende's investment portfolio has had a negative impact. But we still believe that we're on our way to reach those goals of doubling those income areas during the next 4-year period. We have overall also this quarter a positive profit contribution from associated companies. We've seen a very strong return on equity from Brage, our leasing and financing company, actually with 11% return on equity this quarter, also giving positive effects on our profit and loss sheet. We see that the share of profit from Frende Insurance in this quarter was strongly negatively affected by the negative financial return. Of course, as the well-known market turmoil hit also Frende and their investment portfolio this quarter. And on the other hand, we had a divestment of 1.2% in our ownership in Frende due to 10 smaller savings bank joining the ownership side of Frende, increasing the distribution power, of course, of Frende, and as such, increasing the possibility of positive value increase in Frende. So that gave us also I'd say a positive gain on sale. Another important thing for us to mention is, of course, the strong development we see and also the increased investments we do in distribution of insurance. In the summer, we actually, 1st of July, we acquired a major ownership position in Sørland Forsikringssenter, an insurance agent with close to 20 employees with specialized in sale distribution of insurance. And through this acquisition, we acquired both a lot of very competent insurance salespeople and strong distribution power, adding on to the bank's distribution power, and as well an insurance portfolio of more than 100 million NOK. And through this acquisition, we definitely have strengthened our distribution power and insurance sales force, and we see that already a very positive impact on our income from insurance sales. And this will help us strongly to increase our income from sale of insurance and also reach the goals we have in this on this area, which is a doubling of income within insurance. We see also a very positive increase in commission income from mutual funds, very much enabled through the strong customer satisfaction with the Norne Funds portal, which gives us a very strong instrument for digital distribution of investment funds. And we see a strong growth both in number of savings agreements and also the amount saved through these agreements. So over the last 12 months, the portfolio growth was close to 30%. And we have an ambition, and we believe that we will reach that ambition to increase commission income from mutual funds by 100% in the period up till 2025. So we're good on our way to reach that goal. We see in parallel a very good situation on losses, a very low level of losses, and a continued low level of non-performing loans. We see actually a positive development on losses, as well as a very stable and low situation when it comes to non-performing loans. On a very low level, it's been reduced during the last years continually. So we believe we have a very strong situation when it comes to loan losses and also non-performing loans. Our loan portfolio is, we believe, quite low risk and well diversified, both when it comes to retail and corporate market distribution, as well as the geographical distribution. Of course, Agder, which is, I'd say, the main stronghold of Sparebanken Sør has a large part of the loan volume, but it's also diversified through other counties. That is Vestfold Telemark, which is important for us, Rogaland. Oslo and the greater Oslo area, of course, is also a very important part for us with Oslo having about 10% of the market of the gross loans. When it comes to the retail loan book, quite diversified, low risk. 98% of our retail loan book is mortgages with a very low loan to value. And it does show a very robust loan book, as well as a loan book with a huge potential of having positive impacts by new capital standards like Basel IV, the introduction of Basel IV, and of course the work we do to get an IRB acceptance from the Financial Securities Authorities, FSA. Our corporate loan book is also, we believe, quite strong. It is 50% property management, and with a very large amount of these loans being smaller loans. It is well distributed, also, and very much a reflection of the business sector of our main geographical area. On the other, though, with one exception, that we have very little exposure to volatile industries like shipping, oil and offshore, etc. And as you see here, a very solid asset backing in the commercial real estate portfolio. That is the property management part, with a loan to value distribution, which is very strong. A large part of this being with the loan to value of less than 70%. So to sum up, we believe we have good profits from the ordinary operations in the first quarter this year. Positive development in net income, positive profit contribution from associated companies, net entry on losses on loans. And which drives it down is, of course, the negative profit contribution from the liquidity portfolio. Again, a result of the market turmoil that we all are aware of. The funding and capital structure is good. CET1 capital ratio of 16.7%, well above the government requirements. Solid leverage ratio, among the best in the Norwegian banking market, of 9.3. And again, a very solid financial structure, good liquidity buffers, and solid growth during this quarter, though, or during the last 12 months. And we see a positive growth going forward. And to sum up, good profit from ordinary operations that gives us a profit before tax of 355 million NOK, and a return on equity of 7.8% in the first quarter of 2022. Let me go fast through the funding status. We have a very solid and diversified financing structure. Of course, the market turmoil is challenging for most banks, but we still believe that we're tackling that quite well. We have a solid and good deposit loans ratio of around 55%. We experience a very good access to funding, either through the domestic markets in Norway or the international funding markets, especially in the euro. 60% of our covered bonds are issued in euro, and we also issued 2 billion NOK in a green senior bond debt in the first quarter this year. Another thing to mention is, of course, that we're rated A1 by Moody's, and of course the covered bond company of Sparebanken Sør is AAA rated by Moody's. So quite a comfortable situation, even in this fairly volatile situation in the financial market. Fairly solid and diversified financing structure helps us in this period. When it comes to the capital, we have a situation with a well-capitalized bank and a very high leverage ratio. We have a common equity tier 1 capital ratio of 16.7 and the leverage ratio of 9.3, which puts us among the leading Norwegian larger banks. And all this well above the capital requirements of Norwegian authorities. And we are today quite well positioned for the higher capital requirements that will come and that we see come. We received our final Pillar 2 requirements last week, which were actually reduced somewhat. They're now 1.7% reduced from the previous period by 0.3%. And compared with the increase in systemic risk buffer that will come this year, and of course increases in the counter-cyclical buffer, we will have the CET1 requirements of 15.2 and also a soft Pillar 2 guidance of 1%, which gives us CET1 requirement included the Pillar 2 guidance of 16.2, and that is our target today. Our CET1 is 16.7. Through the introduction of the banking package now in June, we will see an increase in our CET1 of estimated to 0.7%. And through retained capital, that is capital building based on retained capital, we believe that we'll at the end of the year be comfortably above 17% and well above the requirements from the authorities, and also well above the increased requirements that comes through the increase of the counter-cyclical buffer next year at this time of 0.5%. So again, Sparebanken Sør well positioned for the higher capital requirements that we see are coming. Another important part for us to mention is, of course, how we're going to improve capital efficiency during the next years. We're in the process of submitting an application for the IRB Foundation approval at the end of 2023. We expect that to take about a year processing from the FSA. And to sum up, quite a significant number of project deliveries are completed and implemented, both when it regards to data warehouse establishment and development, the next generation, so enhanced credit processing, and of course building competence and structure in the bank to be able to actually develop these models and be able to actually implement and apply and actually get accepted as an IRB bank from the FSA. And looking at the difference between Sparebanken Sør on leverage ratio and comparable other regional banks in Norway, we see that there is a large potential for increased return on equity through an IRB process, or as we see will happen anyway, the introduction of the Basel IV rules in 2025. We've also introduced a new dividend policy. We're introducing customer dividend, which we believe has a large potential for us, both to strengthen satisfaction and increase attractiveness for our customers, and all this is, of course, enabled by our equity structure. And this will have effect for the year 2022. That means that we will be able to issue or give customer dividend at the beginning of 2023 with effects on the 2022 results. And there are both a lot of positive effects on the customer attractiveness or the attractiveness of the bank seen by the customers, and of course under current tax regulation and tax effect that will improve the return on equity of the bank. by an estimated 0.4%. So this shows some examples of customer dividend. We believe that that will be a very strong instrument for us to grow the bank and improve the customer satisfaction, and at the same time give some financial positive effects that will benefit the bank's bottom line result. We're also revising dividend policy now, with a payout ratio to be applicable to both equity capital classes, and we want the equity certificate ratio to remain at the 40% level. That is also an ambition to have no dilution through the payout of dividends and gifts. And of course, we believe that the new dividend policy will give us both the ability to facilitate growth and yield attractive direct returns to the equity certificate holders, and will also enable us to allow for sufficient customer dividends, as well as gifts and donations, which is a part of our business. And this illustrates our profit allocation with the new structure that we have now decided in all the in the bank's governance structure. We're only waiting for the FSA's approval of this new structure, which we hope we will get in May this year. That is in this month. So let me take the last part, goals and expectations. We have increased our financial ambitions with the ambition of a return on equity of more than 11% by the end of 2025, and an ambition of more than 10% by the end of 2023, with a CET1 capital ratio ambition of 16.2, increasing to 16.7 next year, and a cost-income ratio of less than 40, and a payout ratio of 40 to 50%. Let me sum up what I believe is a positive future prospects of Sparebanken Sør. We are today the market leader in the Southern Norway part. We have a high customer satisfaction and loyalty and a stable and high customer loyalty. We have a quite low risk loan portfolio, and that has been consistently over the last 10 years. We have high cost efficiency, one of the highest or best cost efficiency in the Nordic banking sector, and definitely low complexity. For us, the low complexity is quite important. We have an ESG leadership with rankings from and ratings from Sustainalytics, which rates us among the best, actually best Norwegian banks, and among the best global banks, among the best 3% on the ESG rankings of Sustainalytics. And that gives us an edge and motivation to work on to improve our ESG position. We're introducing, as I've been mentioning, the customer dividend, which will increase the customer attractiveness and I would say the value proposition that we have to our customers. And we've introduced a number of measures that will help us to increase the return on equity during the next years. All summed up, we believe that all these actions and this strong position does give a positive effect on the equity certificates, equity capital certificates of Sparebanken Sør. So again, we believe that we have a strong proposition both for our customers and for equity capital certificate owners. So those were the main parts of the Q1 presentation. So thank you very much for your time and attention, and have a good day. Goodbye.